Hello, everybody. Welcome to Friday. Really fun show today. This is our Go Live with Tom, something we do every Friday from 12:15 to 1 o'clock, Pacific time. And the object of this is pretty simple. This is a Q&A show. You send in questions and we'll answer them. Our main focus is on, financial planning and tax management and investment management. We have a couple of questions that came in this week, so you can send them in anytime, but you can also send them in during the show. So feel free, to send them to the email address that's right there on the screen, asktom@golivewithtom.com. And then Eason, who's with me today, he's another advisor here at Retirement Capital Strategies. He's going to be our moderator, so the questions will come into him, and he can ask me, and then he'll ask some follow-up questions and such too. So we'll try to, kind of flesh the concept out some. And so, really fun event. I mean, we believe here at Retirement Capital Strategies that investment knowledge and financial knowledge helps people to build their wealth faster. So we provide a daily video every single day that we talk about what happened with the market and how that relates to the accounts that we're managing. And then we're doing this Friday event to purely build investor education. And so that's been really fun. And then we're also working on some subject videos, some more deep dives. For example, working on a video right now on, our favorite cybersecurity ETFs. And cybersecurity is a really hot area right now with all these different ransomware things that are happening. So if you'd like to get notification of those videos as they come onto our channel, you need to subscribe. And so there's a subscribe button right there that you're probably looking at. You're on our channel right now. And if you want to get an email when we post something on there, you can click the little bell and that'll come to you also. So look forward to that. So let's get started. We've got some great questions already, and then please send in anything else. And so why don't we start off with the first question, Ethan?
So the first question of the week is, what is the best way to get income from for retirement?
Best way to get income for retirement. Yeah, okay. When we look at retirement, there's a lot of things besides income. There's a lot of things besides finances that are really important. Your health and your family and just your enjoyment as a whole, your satisfaction with your retirement. But in terms of finance, when we're looking at all the different financial aspects of it, obviously income, I think it's probably number one. And it has that ability to kind of, make your retirement more successful and more satisfying if you have enough income. I would answer this question though first by just a discussion about expenses because I think it's super important. If your expenses are so high that no matter what you do with the income side, you can't meet those, you're going to have some troubles and you're going to have a very dissatisfying retirement. And so the first thing that I would notice within my clientele, and I think this is one of the advantages that I have. I've been doing this for 35 years. I've done over 6,000 financial plans. And even more importantly, I can work with, let's say, an 80-year-old, and I'm able to look back over their whole life path and talk to them about what they did. And I can compare an 80-year-old that's been very successful with an 80-year-old that hasn't been very successful. And I've noticed some differences. And so that's what I'll try to talk about. So first of all, in the expense side, those retirees that are doing very, very well, they're spending less money than they could spend. And that's true at any age, right? I mean, that's one of the key aspects is to be able to save and continue to save. So let's just say, for example, we have a client who could spend 100,000 a year. Well, and they're spending 70,000 a year. And that's a really big deal. So they have this extra money that they could be spending each year. And what that does is it gives you room for emergencies, house maintenance things that happened. I just had my house blow up because of a leak inside the wall and wiped out a bunch of hardwood floor and what have you. So very expensive to fix all of this. Or if you have kids, anything can happen with the kids no matter what age they are, and you want to have money for that. Or if you have dental issues or vision issues or hearing aids, all of these things are things that aren't often counted in somebody's overall budget. There are things that happen on an occasional basis. And so that's number one. Spend less than you could at any point in time in your life, especially in retirement, and that will help. But then if we break that down just one more step, of that, say, $70,000 that hypothetical person's spending, if you can reduce the amount that is fixed versus variable, that's a huge deal because it just gives you massive flexibility. So let's say, for example, we have one person whose fixed expenses are about 50,000, right? Versus the 70,000 that they're spending. And another person whose fixed expenses are 20,000. The person with the lower fixed expenses has way more room for error. And when things fall apart, they can cut back easier. So fixed expenses are those things, the next time the market drops 60% and you take a look at all of your expenses, those things that you can't get rid of very easily, those are fixed expenses. And the biggest ones are mortgage payments, car payments, those types of things. So most of my very successful clients have no debt. Now, some have a little, but it's very little. Most have no debt and they've paid off their house. So that's something to try to achieve in retirement. It just gives you flexibility so that if you have to reduce from 70 down to 50, you can do that. And just go back to share.
It should work. Yeah. Um,
All right, sorry about that. We're back. We had some technical difficulties. This is truly a live show. We've had a few issues over the time we've been doing this. So hopefully that solves some of the problems here, and we'll just keep going. I was mentioning that again, a retirement that's very successful is one where you're spending less than you could spend, and of those expenditures, you've reduced the fixed expenditures that are very hard to get rid of as much as possible for the rest of your retirement. And so once that's achieved, then it's a matter of generating income to kind of accomplish that. So let me share my screen here so I can show you. This is a thing I call the retirement income builder. And so these are just a whole bunch of different places that you could generate income, for your retirement as far as that goes. And so, we've got stock and bond investments. We have savings and CDs, annuities, alternative investments, Social Security, pensions. I'll get back to those because those are important. And maybe you have rental income, or maybe you have second or first mortgages, investments that you've made where people are paying you, the money back. Maybe you use your home equity. You can do that by maybe moving to a smaller home at some point, or you might continue working for a while as a part-time job or consulting or little business that gets started. I have a lot of clients doing this now, that more than they used to. Retirement's become kind of this fluid thing where people just want to be able to shift to something they really want to do. So if I look at this, the two things that really jump out at me are the Social Security and pensions for starters, because again, my most successful clients have low fixed cost, but they have high fixed income. So I would call these kind of fixed incomes. And it's money coming in from an outside source that doesn't rely upon a renter or the stock and bond market or interest rates at the bank. And what happens and why this is so important, you really want to maximize your Social Security and your pensions. And this is essentially a math problem to figure out how to maximize those. We use financial planning programs with Monte Carlo simulation to figure out the optimal age to take Social Security and the optimal choices to make for pension distribution. So that's very, very important component. Again, my happiest clients, the ones that are the most relaxed, are the ones that have the most money coming in here and have very little fixed expenses. So it just gives them tons of flexibility. But your distribution from these other areas, assuming that these two, pension and Social Security, don't meet everything you need, really you have to take a look at, should I have rental income? Should I be investing there? If you already have that, great, but do you want to add to that? Should you be taking money from stocks and bonds? Should you take money from IRAs first or from your non-IRAs first? And so what we call the sequence of withdrawal from the rest of these is incredibly important, and it really makes a big difference. It's one of the things that we kind of figure out in the financial planning process as to where to get the income from these. But you should have a fairly robust system of income potential. And that is really, having a lot of these different circles filled in so that you have something to fall back on in case one circle doesn't work. Having everything you own in any one of these circles could work if it happens to be a great circle, but it also has that risk of really being an issue with lack of diversification. So diversify your income sources as much as possible is what I'd recommend.
So if I like for me, I don't really have an option of pension, and pension's kind of falling off with my generation. Is like what's a good way to fix it? Because right now, if I'm my options are 401ks and IRAs, which are kind of dependent on the market. Is there any way I can get that fixed income? Do I turn to annuities?
Yeah, that's exactly what you do for most pensions are farmed off to an annuity company. Some of the big ones aren't, but a lot of them are. And so the company will accumulate a certain amount of money and then give that to an insurance company to produce an income for life. So you could make a pretty good argument for, using what's called an immediate annuity. They're fairly efficient, where you would accumulate some assets and then turn it into an immediate income that comes out for the rest of your life, maybe the rest of your spouse's life. You got all these different options as to how you do that. Um, I look at that personally, and that's one of the things that I plan on doing. Again, I have sat across the table from thousands and thousands of people and watched, what's happening in their retirement. And I'll tell you what, the people that have lots of money coming in here in this fixed income area are very, very pleased and very happy. Now, the problem is it just kind of depends. You can't put, if you don't have that much money outside of, say, Social Security, then you probably don't want to do an immediate annuity and wipe out all of your liquidity in these other places. So, this would be something where I'd be looking at more like a 10% or something less than that in this area just to generate, an income for life. And so, again, if you don't have tons of money, that's probably not worth it. So the value of your entire, asset growth has a factor in this. But yeah, that's one of the ways to take a look at that. And obviously I like the stock and bond investment area. So another way to kind of make sure that you've got at least some security there is to have more in the bond market. If you have 60% in stocks and 40% in bonds, a bad bond market isn't nearly as bad as a bad stock market. So that at least gives you some security for a chunk of your assets that'll be there, more likely for the long term. So, that's a good question though, and it's an interesting area. Again, it depends on how much assets you have as to what you can really do. I mean, if you don't have enough assets to buy a home to create a rental income, that's not an option, for example. But so it depends.
So what are your thoughts on, reverse mortgages and using home equity as kind of a to make a kind of a fixed income too?
Yeah, home equity comes out in two ways that I've seen. Number one, and we currently have licenses or clients in 26 states outside of California because people have taken their, basically high value home here and sold it and moved someplace else that's cheaper. And then, so they sell something for 1.5 million and buy something for 500,000. And that extra $1 million, after tax goes into really kind of their stock and bond investments, which can then generate income, right? So that's one way of doing it, is to actually move. And a lot of people have done that. The other way, if you don't want to move, is this concept of the reverse mortgage. Now, the problem with the reverse mortgage is that they're not the best deal when you really dig into them. They've gotten better. They used to be really bad. You really want to use that as sort of a last resort. So when all of these other things are exhausted and you don't have enough money to really make some of these other things work, and you're sitting on, $1.5 million worth of equity in your home, so basically you're home poor and you really don't want to move, then a reverse mortgage is probably your best option in that particular regard. And there's different ways to do that. You can kind of do a quasi reverse mortgage by just getting an equity credit line and withdrawing, small amounts per month to live off of. And there's a whole bunch of different ways to do that. But nonetheless, yeah, that is an option. But it would probably be the last thing on my list. Once all these other things weren't enough, I would be looking at that. Again, only if I didn't want to move, which happens actually quite a bit.
Cool. So we talked about the market a little bit. What is there a time and place for, index investing rather than like an active strategy?
Yeah, that's kind of the two different concepts, and let me just describe those really quickly. So active management, and you can have active management in different types of vehicles. You can have active management in what's called a mutual fund, where they're buying stocks and bonds, and you got a manager that is in charge of that, or a group of managers that's trying to, research and pick the best ones. And that tends to be more expensive because you got to pay for that management. And then you have this concept of the index, which really started back in 1975. It was started by Vanguard John Bogle. And so the concept there is they would just buy. The first one really was just buy the S&P 500. So there's no manager, there's no real thought about it. Whenever the Standard and Poor's changes a stock, they have their own screening system. Then they change it on the index. And you have now, though, filled in a whole bunch of gaps in between active management and true passive management. You have some of these indexes that are rebalanced every quarter, and there's a whole bunch of different things that happen. But yeah, actually, one of the things, in my opinion, if you're trying to build money and you don't have a lot of money yet, would be to take a look at something like the Vanguard Total Stock Market Index. It's the ticker symbol is VTI for the exchange traded fund. And we use this. We have a big position there. I really like it. And what they do is buy almost every stock on the U.S. stock market. And it gives you great diversification. You don't have international there, but you can also, if you wanted to, add the Vanguard Total, international stock market. VXUS is a symbol. We don't have a big exposure to that right now, but it is something that's starting to move right now. So it's something we're looking at. But um, we do have it, but nonetheless, so those are like two stock market pieces that you could use. If you wanted some, more bond in there to bring down the risk, you can use the Vanguard Total Bond Market Index, which is BND. And if you wanted international bonds, you can use the Vanguard Total Bond International Bond Index, BNDX. So those four pieces, right? You can make a really simple portfolio with a very, very small amount of money, even hundreds of dollars, and then just keep adding to it and building it up. Over time, as you start to get more and more assets, things get more complex, and there's more things that you can do. But yeah, when you're first starting off, actually, the index concept, and especially in my opinion, the Vanguard index concepts, those four ETFs would be a great place to start. You can usually pay, nothing to buy them. The internal costs on these indexes are really, really, really low. I mean, the cost is negligible, and you can buy, I think there's over 3,500 different stocks in the Vanguard Total Stock Market Index. That's essentially the whole US stock market. You can buy all of that with one purchase, aligned by capitalization, for free at most places where they don't have any ticket charges to buy that. So I really like indexing. I think it has, a place in the portfolio. We've been doing at least some version of indexing since the 90s. We've been pretty early in that, and really it's been fantastic. I love that now. I still think there's a place when the size of your portfolio gets big enough, that kind of 200, $500,000 to really, diversify out into some other areas, including some actively managed areas, which still can work. But I would start with the indexing.
So you're saying there's like a young investor in their 20s, easiest way is kind of just have it in an index fund and kind of set it and forget for a while and just let it grow. So
Yeah.
just have that monthly deposit and keep going.
Yeah, especially if you're able to add to it. That's super powerful, right? Yes, that would be a really strong strategy. I mean, Warren Buffett says the same thing. He talks about just buying the S&P 500, which you can do through Vanguard's, VOO is the ticker symbol. And so, yeah, no, I think that's a really, really great way to go. Now, if you're really into it and you really want to get into it, there's a lot you can do. A lot of these people that started out in Robinhood last year didn't start with that much money, and they've been doing all kinds of different strategies. But if you're just looking to kind of build some assets and you're really interested in other things in your life, then those indexes that I just give you would be a great place to start, and a really good place to just set it and forget it, as you said, and just keep adding. to them. And you don't need to really pay somebody like me up until a point where you really get more complex. You get at 250, 500,000. Then there's things you can do with the portfolio that are worth looking at.
So going off that, what's the difference between exchange traded fund and a mutual fund? Is there any
Ah,
like pros and cons to each
yeah.
of them?
So exchange traded funds, also known as an ETF and a mutual fund. So mutual funds were first. They're the oldest. They go back to 1920s, I believe. Late 20s is when they first started. And the concept behind a mutual fund is that they're going out and creating a basket of securities. Stocks or bonds are the two biggest ones. And what they're doing inside there, for the most part, is holding on to that basket. Sometimes you have a manager, and so that manager's buying and selling, say, stocks for you. Those are usually more expensive. You can buy index mutual funds, which don't have a manager. You can buy the S&P 500 inside of a mutual fund, and just those are a lot less expensive. Um, and so then an ETF came along more recently, has the same aspects of the mutual fund. It's a basket, a grouping of different stocks or bonds. There are some actively managed ETFs, but most of them are passive indexes, as far as that goes. So pros and cons. On average, ETFs are cheaper on the internal expenses than the mutual funds. So that's one of the things that really drove me towards exchange traded funds over mutual funds, is that they were just cheaper. And then secondly, right now, when you look, I mean, we clear our business through TD Ameritrade. If we want to buy or sell a mutual fund, it's fairly expensive. It's like $24 to buy or sell a mutual fund, but I can buy and sell a exchange traded fund for free. So that's actually another really big difference, right? I like no transaction costs on the exchange traded fund. One of the other big differences on exchange traded fund versus a mutual fund is an exchange traded fund can be traded at any minute of the day. Mutual fund only trades at the end of the day. And so, if the market's falling apart that day and I want to get out, I can't. I have to wait until the end of the day every time to sell on a mutual fund. Whereas an exchange traded fund, I can, kind of get out if they're, or buy it for that matter, in the middle of the day instead of having to wait till the end of the day. A couple of other key things that I think are quite important is like one of the things that happened, we had a tremendous run up, right, in the accounts, from the election all the way through the middle of February, and we had just things that were going up farther than I've ever seen in a short period of time, and it made me very nervous. And I wanted to put stop losses in place to be able to protect some of those gains, so we didn't get wiped out when it came back down, and it did come back down. And so you can't, a stop loss is where you just kind of draw a line, in the sand, so to speak, and you want to sell when it gets to that point. And I'm simplifying this, but you can't do that in a mutual fund, but you can do that in a exchange traded fund. So I do like that. I like that capability of being able to get out during the middle of the day and to put in a stop loss. At some point in time, there's all kinds of things I could put in: buy orders above or below the market. I can put in sell orders above or below the market, all things that you can do with an individual stock. So an exchange traded fund is like a combination of an individual stock and a mutual fund. I think it's the fastest growing area in the investment arena right now, is just that area of the exchange traded fund, and we use it a lot. I love exchange traded funds. It's one of my favorite pieces. So I think they have a lot of advantages. They're cheaper, both the transaction costs and internal costs. On average, you can get in and out. You can set stop loss. You can write options against them. So you can do covered calls, put options, all kinds of things that you can't do with a mutual fund. So just a lot more flexibility. I think everybody's kind of waking up to that at this point in time.
So you think using mutual funds is kind of like a thing of the past, and now ETFs is the way to go if you have like a kind of like a comparable one?
Yeah, I think that's right. I think that's exactly what's happening. The outflows out of mutual funds has been quite high, and the inflows into exchange traded funds has been quite high. So I think what we're seeing is a rotation to a better vehicle. We'll have to see. we did get a chance here to see, in the 2008 downturn, how exchange traded funds hold up versus a mutual fund. Is there price distortion that happened? There was some, but nothing that would scare me out of those. Sorry. We also had a downturn just last year. Saw some price distortion in ETFs, but they did quite well actually. So because that's one of the pieces that people look at. They're exchanged by the day instead of just at the end of the day. So yeah, I definitely think the rotation to exchange traded fund is happening. I don't know that mutual funds would be a thing of the past, only because there's just amazing amount of money in them in total. And no matter what the situation, money tends to stick around, at least some of it, right? So there'll be plenty of money in some of these mutual funds, going forward. But
So another question, going off it, you saw that you talked about Robinhood, and I've seen a lot of people make big profits investing in these meme stocks, and I know a lot of my friends and younger investors. There's a draw to these stocks. Do you have any tips? And some of my tips would be is have a plan. I think a lot of people go into these with kind of it's an easy way to get rich. I can hit a home run, and I know one of my friends, he invested in AMC and lost probably half of it in the first month. And he sat by his pit. He held on for dear life, and he got lucky when it rebounded in those last couple of weeks and took his profits and got out. But as a younger investor, it's handling those volatilities, and sometimes it costs money to learn these lessons. You got any tips for younger investors, Tom?
yeah, I think it's kind of fun. It's a distortion. I worry a little bit about what that distortion means, for the market as a whole. Uh, but it's always the same issue. Yeah, you still have to get in early, right? And so that's not always easy. A lot of times, by the time you hear about it, unless you're really, really plugged in and really following things, you might miss out, and you get in towards the end. Because there's no justification for the pricing of AMC, for example, at all. Matter of fact, you can see that the insiders are selling their stock like mad, so they can't see it. And so theoretically, at some point in time, these things tend to work out, which would mean that price would come back down. It could come back down fairly, radically at some point in time. Um, and so if you can get in early and you want to play the game, there's nothing wrong with playing games. Just keep your investments small. I mean, I have a client that invested $14,000 into Apple when it was falling apart and looked like it might go out of business before they got jobs back, and now it's worth $2.3 million. And so, keep the investments fairly small. If it's really going to work and it's really that great, you can generate a lot of money. Don't lose your net worth on these things. So that would be a tip. Just keep it small. If it's going to work, that small will still turn into something pretty substantial. Um, I guess my biggest tip though is just be super careful, because right now what I'm seeing, I'm seeing the same thing. Cryptocurrency went from really Bitcoin to now what, over 5,000 different cryptocurrencies. When you dilute the market like that, what you're doing is diluting the supply to any one particular cryptocurrency. We're starting to see that with the meme stocks. We went from GameStop and AMC basically to now Wendy's, and different stocks that are moving all over the place. And as soon as that starts to happen, there just aren't enough people to drive all of them. And so, is the one that you're investing in going to work? And would you do AMC right now? Personally, no. It's already had a huge run, so you're really looking for the next one. And is the next one going to run with everybody else being diluted by all these other different meme stocks? So, it's a game. I think it's fun to have fun. We all spend money on different things that we have fun with, but I would keep the bets pretty small, just because you got to figure out how to get in early, and then getting out. That's not easy. Like your friend said, got in, hung in there, probably got lucky to a certain degree that it came back, but it's really difficult to get out at the right time and actually make a profit. So it's it's such a fast moving game. You're playing in the big leagues there. I hope it works.
Yeah, I guess you could talk about how it's like kind of like a bandwagon effect where
Yep.
everyone's just jumping on this
Yep.
bandwagon, and some people are going to get left on the bandwagon while everyone else jumps ship.
Yeah. I mean, are you on the side of the bandwagon, barely hanging on, or did you get on early and you got a nice seat? And so, and that's the key. That's true with all investing. Now, it's just exaggerated in the meme stocks because they move so fast. That's true in all investing. Did you get in, at an adequate time so that whatever run that stock might be having, you're still participating in that, or did you get in at the end of that run? And that's where you lose money, right? I mean, that's pretty easy to see, but and so that would be my strategy for looking at meme stocks would be probably to ignore the ones that had already run. And I would get in on those, Reddit boards and what have your Wall Street bets. And I'd be just watching for what they were talking about. And I'd make small bets on, say, three or four different ones, that are not already running. And see if we could get in early enough on some of those other pieces. And, if it didn't work out, okay, great. I'd love to see the logic behind it, although that might be a deterrent because I think there's not as much logic as there needs to be, and maybe you don't need logic if everybody starts buying it. It doesn't matter. So, uh, you know, I would probably be diversifying my bets, try and find two or three other stocks besides GameStop and AMC that I could get involved in and put some small bets on all of them and then see which one runs. If something does run, I might add to that bet. If I get one right, I might continue to add to that bet. And if something, doesn't, then, move on. Yeah.
So I have a friend that kind of does this. He likes to take small bets on companies,
Hmm.
but his strategy is that he lets if a company runs, he'll always liquidate a portion of it, capture profits, and then he just keeps like siphoning off more and more of the funds as it grows. And then at the end, he only keeps one share and just lets that one share run forever, essentially, so he can stay on the roller coaster. But
Yeah.
he likes to capture his gains. What are your thoughts on that kind of strategy?
Well, I'm much more of a let my gains run. If I don't believe that that particular holding I look at it like a team. So I might have, like right now, I have, say 14 pieces in my portfolio. I look at those 14 pieces as the starters, and then the other, say, 2,300 ETFs that are out there as the bench. And so when I have something that's running, I have to compare it to the bench. Do I have something else on the bench that's doing better than that and running harder and I feel better about? I might replace that completely. I usually don't pick on pieces because I got somebody else on the bench who's going, I mean, really doing well. And but saying that, I can also have starters that are just, I get in there, and so I have a big belief that you cut your losses quickly and you keep your winners running. And so now I'm not dealing with individual stocks. It's a little bit different. I'm dealing with entire, segments of the economy when I'm buying these ETFs. But I tend to basically keep things going. I'll hold on to something for, as long as I can. I mean, I give you an example. So last summer we started buying clean energy. A lot of that stuff doubled by the middle of February or more. And I wouldn't have wanted to sell part of that. If I still believe in it and it's still running and I still think there's some reason for it to continue to run, I don't want to take a part of that off the table because it's so hard to find winners. I want those winners to go. Now, if I have something else on the sideline, let's say genomics or innovative technology or something else that all of a sudden takes off and does better, because clean energy replaced some of the large tech companies that we had. We bought a lot of large tech companies right during the downturn because they were holding up so well. But then the summertime, clean energy started taking off. And again, large tech was still a winner for me, but I actually just replaced it and put in clean energy, and I let that run up until the middle of February, end of February, when our stop losses hit. So I'm much more a believer in just kind of, if you have a winner, they're not that easy to get. As a matter of fact, I get way more losers than winners. But my key is I just keep getting rid of the losers, fairly quickly, within weeks sometimes. And if I have a winner, I just let it continue to go. So like right now, my big winner, that I have, I think we're up about 15%, is Invesco Pure Value Mid Cap, right? RFV. Uh, and I'm, that's still rolling. It's still going. It's up today. It's not up every day, but that's a winner for me. And I'm going to keep doing that. But I've had a bunch of little pieces that didn't do so well. I got involved in regional banking that we just moved out of a couple days ago. So that's cut your losses, keep your winners. I could see what he's doing there. There's some logic to that, and maybe what he's dealing with would work better in a more volatile environment, which he might be in. And so you could lose your gains so fast that you got to take some. I'm not in that environment per se with these ETFs, so it's maybe slightly different strategy, but again, it's not that easy to find winners, and so boy, I really cherish those when they happen.
Do you have any tips for people, cutting their losses? Because I know some people just hold on for dear life, even though like my one friend in AMC was down like 50%. And like, is there kind of like the bias that like it'll get, if it's hit this point, it'll come back eventually, and people get stuck on that point?
Yeah, I can't afford. I'm dealing with life savings, right? I mean, let's face it. For the most part, for most of my clients, I have all their money, and they're either going to retire or they are retired. And if I lost 50% on something, it would be a total disaster. And that's a key success point for retirement is don't lose 50% on too many things if possible. So really, I tend to cut losses a lot faster than that. A 10% loss would be a pretty big disaster for me. Again, I'm not dealing AMC's, motion is really amazing, right? I mean, it can move 30% in a day, a little bit of a different concept. Um, but I tend to cut losses pretty fast and just move on to something else. Now, it worked for him. He stayed in there and kind of got going again. But that's not always the case, right? I mean, a lot of times things get damaged and nobody wants that damaged goods any longer. Um, so again, I tend to cut my losses pretty fast. I don't have a specific rule, like 10% or 5. Again, a lot of it has to do with the bench. So for example, right now, we just sold our regional banking piece, which I think we were down about 3% in total when we sold it. And it just wasn't doing as well as some of the things on the bench. And one of the things we're seeing right now is a turnaround on some of these pieces. And so I bought a clean energy piece, which is doing great today, which I'm very happy with. And so, I'm watching that on my bench. I think that has more potential than the other thing. So if I'm sitting on AMC and it's dropping, I might be selling it earlier just to be, I have something else. I've got someplace else to go. Well, your friend was waiting for that thing to come back. Maybe he's off to the next one, gets into Wendy's or something, I'm saying. So I tend to like look for the next runner, look for the next runner, look for the next runner, get out of the ones that aren't running. And again, I look at it like a team. I used to manage a soccer team, adult soccer team. I played soccer my whole life, and I look at like bench versus starters. And sometimes the bench, somebody on the bench starts playing better than some of your starters. I don't have any problem with replacing the starter with somebody else.
So a bit of a change of pace. So this is a question from email in question. The day before tax day, my accountant told me I could contribute $7,000 to my Roth. I haven't set up an IRA or a Roth, and now I'm trying to learn more about them. What's the pros and cons of a Roth IRA versus a traditional IRA, and or just a regular brokerage? And is there any advantage to having both of them or having it kind of stretch across the three? What are your opinions?
Okay, so there's a couple questions there, really. So one is about when you can contribute to a Roth IRA, for example. And it is kind of interesting because a Roth is different than a regular IRA. A regular IRA, with a Roth, there's an income limit for how much you can make. And so if you put money in a Roth and you happen to exceed those limits, the limits right now are, I believe, they start phasing out at about 198,000 for a couple and 125,000 for a single person. Um, and if you exceed those limits and put in too much, you actually can get penalized. It's a 6% penalty per year. So putting in a Roth before you know for sure what your incomes are going to be can be a little bit dangerous in that respect. Now, if you know for sure you're not going to be above those income limits, then you really want to put the money in as soon as possible, which would be January 1st of that year. But otherwise, you want to wait until after your taxes are, being prepared, so you really do know the income, and you would make that contribution up until April 15th of the following year. So for example, if I want to make a contribution for 2021, I can wait till April 15th of 2022 to make that contribution. Um, but it's a little bit different in that regard because there is an income limitation that you have to be careful with. Um, now, uh, the other aspect is just comparing. Question part here was comparing a regular IRA versus a Roth IRA versus just a regular account. I'll call it a taxable account. And really, it's kind of interesting. So a regular IRA grows without any taxes until you withdraw, called tax deferred. A Roth IRA grows without any taxes, and then you don't have to take anything out, pay any taxes when you take it out. That's tax free. All right. But both of those have a penalty for taking money out before 59 and a half, right? Uh, and so that's one thing to consider versus a taxable account, you have no penalties for getting that money out of there. A regular IRA will give you a write off. So if you're desperate for a write off, that would be a better choice. In my opinion, if I'm choosing between a regular IRA and a Roth IRA, I'm going to choose the Roth IRA. I've already converted all of my regular IRAs over to Roth. I've converted my 401k to only 401k Roth. Everything I have. I have no future tax liability on my retirement accounts, mainly because I've seen what happens to everybody that ends up with a bunch of money in their regular 401ks and regular IRAs. So that would be my choice between the Roth and the regular. And then the taxable account would be fairly equal to the Roth as far as I'm concerned. I want to build assets up into both of those areas. So if I had to choose between the three, I would choose a Roth IRA, and I would continue to add to a regular taxable account to build up that liquid asset because that regular taxable account only has a capital gain that I have to pay, which is lower than normal taxes as long as I hold on to it for a year. So that would be the best tax structure, and I think the best flexibility is a regular, a Roth IRA, sorry, and a, taxable account together. And I think that, is a winning strategy as far as that goes. So yeah, it's one of those things that's a little bit confusing in today's world, and it does keep changing. But that's what I'd be recommending today.
So I've heard some things where you try and set up a Roth IRA for your child. Is there any things that you would like do for that? Because I know they have to have income just
Yeah,
to do it. So
well,
is
that's
that
the
the
biggest
major issue?
challenge. They have to have income. I mean, it's pretty awesome concept to think, oh, I got this 2 year old. I could put $6,000 a year, into this Roth IRA for them. Just keep doing it and doing it, and then they could take over and do it themselves. Oh my gosh, it's amazing, tax free, massive amounts of money by the time they get to retirement. And the statistics are unbelievable. When somebody starts saving in their 20s versus their 30s or 40s or 50s, it's incredible how much more money. But you have to have income. And so, it's very hard to justify, and, even if you have your own business, employing your 2 year old. So, once your child does get a job, and you can contribute. I mean, my daughter had a $1,380 in 2019 of income from the pizza place she was working at, so she could put $1,380 into a Roth IRA. The max she could do is 6,000, but the it's either the 6,000 or what you earn, whichever one is lower. So for her, it was 1380. So yeah, that's one of the issues with trying to do this for kids, is just that aspect of needing earnings. One thing you could do, and I have done this for a couple clients, you could just set up a regular taxable account, start putting money in there, and it's in your name and what have you, but it's mentally it's for your kids, and you're building that up. And then once they get a job, you just use that money to kind of fund their, match their pay up to $6,000 and just keep putting that money slowly but surely into Roth IRAs. And so that, it's a way to So at 2 years old, you could start saving for that kid and for that Roth IRA in a separate account. There's some tax issues and what have you, but that's a strategy I've actually used with a couple clients. They're very interested in trying to make sure their kids are well set up in retirement. You can do the same types of things with college planning too, but that's a different story. Good. Well, that's our session for today. Thank you very much. Apologize for the little technical glitch we had, but we'll get this figured out. So appreciate your questions today. Very good questions. Really fun to do this. And again, if you're interested in getting additional videos, pieces of this particular live stream that we put on our channel, you just want to hit the subscribe button, hit the like button, not the like button, but that'd be fine too if you want to, but the little bell that is right next to usually the subscribe button. You'll get notification when we post these videos. So thank you very much for coming today, and I look forward to seeing you next week.